Alan Uckman, Chief Market Strategist at Agora Financial, joins us live from the CME in Chicago. Alan, always a pleasure having you on, and thank you for joining us. Now, it was only a week ago that it appeared that volatility might be coming back into the market, but over the past week, and certainly towards the end of last week, markets seemed to be calm once again, and investor confidence was on the rise. I think the VIX had quite a big tumble last week, and it's now back below 10.
Yeah, we actually peaked out around 1450 on the Thursday before last Thursday, but it's been straight down since that time. And like you said, we're below the 10 handle one more time. 10 and 12, that's been the range for 7 months. Periodically, we get below this 10, but the downside target of that $2 range is still 8. We haven't been able to get that to that level yet. So let's see. The way the markets have set up, after a key reversal we saw last Monday, where we made new all-time highs in the S&P and saw a lower close, that was a little bit of a caution sign, but it looks like that's being erased now, and we're about to make new highs or very close to it once again. In all of our major market indexes, we were only about 0.5% or 1% away coming into today. So it looks like it's going to avoid that topping pattern once again, and you can't argue with this market momentum.
Yeah, absolutely. Alan, are you expecting us to break out of that tight trading range at any point soon?
Well, the VIX, yeah, I'm still looking forward to get to 8. Now, I've been saying that for months and months and months. But more important to us is the focus on the stock price, because that's where we're making our money, is trading in the stock market, focusing on the equities market. And I still see a lot more upside in equities. We're in a bit of a pause right now. Earnings season starts again about the second week of January. Typically, December has been a very positive month, and especially with the momentum behind the markets right now, I'm looking for that to accelerate. I don't see any reason that anyone's going to get very aggressive on the short side. Maybe there'll be some profit taking, but even when we saw that in technology, it's bounced back rather quickly once again, and it looks like tech is going to be closing in on those highs once, very soon.
Well, speaking of the tech space, Alan, we're just actually going to bring up a chart for our viewers, which really highlights exactly what you were just pointing out. The FANG flu, if you like, lifted last week with those tech shares holding the S&P rebound from its longest slump since March. Now, if the turnaround continues, and this is fairly significant, 2017 will actually be the first year ever where the index has posted positive total returns in every month. So it's, as we've sort of been speaking about this rally for the majority of the year, it's all been about the tech sector. So, Alan, as we reflect, I suppose, on the year that we've had for 2017, what have you made of it, and in particular that stellar rise for those tech stocks?
Well, again, that just illustrates, why try and be the guy that's going to pick the turn in this market. It doesn't make any sense. Just because we've gone up X amount of months doesn't mean we can't go up further and further. Buy high, sell higher, but be selective in your opportunities and wait for these pullbacks. I think more important to focus on the NDX and to focus on that tech sector is the pullbacks. When the market does pull back, it bounces the distance of that drop on top of those old highs. That's happened every single time so far. So that's still the game to play right now, is wait for those little unwinds and then take advantage of it. Puts you in a better reward to risk situation if you're going to attack the markets after the sell-off has happened, as opposed to jumping on after we made new highs.
And do you think that rally will continue for those tech stocks? You just mentioned earlier that you are positive as we head into earnings season, into the new part of January and into 2018, into the new year, that you expect stocks to move higher. Where do you think those gains will come from, and which sectors in particular?
Well, tech has obviously led the way. It's up more than 30% so far this year. The Dow has had an incredible run as well, but you alluded to the oil stocks are getting a little bit more firm. We've got oil firming up to about $58 a barrel. We've got a double top in crude oil at 59. So if we can get through 60 here for West Texas Intermediate crude, that could give the energy sector another push to the upside. So that's been beaten and battered. I look for that to be a laggard that's going to play some catch up there. But like you said, I don't know if I want to be jumping on tech at these levels. You've got Apple having a big day today. You just got to get into the mentality of waiting for pullbacks and using that as an opportunity. I still think there's a lot more upside. We've been saying that for months, if not going on years. But it's a matter of finding specific stocks that meet your criteria. I still like Twitter. We've talked about that a couple of times, and I think we mentioned it when it came back to the 20 level. Now it's looking like it's going to attack its highs above 22 here. And if it does that, then the target on Twitter is 26. Now, interestingly enough, 26 is the IPO price when the stock originally launched years ago. So it's acting kind of like a magnet, and that's a stock that had kind of been forgotten about and had fallen. But I think there's an example of technology that's coming back to the forefront.
All right, so we've spoken about technology, we've spoken about energy. I'm interested in your view as well on financials, and I know, Alan, we have spoken to you about this time and time again, but we're heading into that Federal Reserve meeting this week, almost 100% priced in. We'll get a move, but it's all about the outlook with respect to interest rate rises, and we know that higher rates will impact the bank's bottom lines. Are you positive and optimistic on the outlook for the financial sector?
Oh, yeah, definitely. That's a sector that's had a great year, but it's still underperforming the overall market for the last 8 years, so it still has more upside. XLF is the way to play the sector in general, the financial ETF, instead of the individual banks. But if you look at interest rates, we're pricing in about a 50-50 chance in March and then another 50-50 chance mid-summer for next year. So the rate hikes are going to continue, but they're going to be slow, they're going to be gradual. And I think that's just one component that's going to be helping out the financial sector. It's got some solid momentum behind it, and I think there's still significant upside there. They have not even come back to where we were back from the 2009 financial crisis. So banks, there's a reason that they keep the money. They make the money.
All right, excellent. Look, Alan, always appreciate talking with you. We do appreciate your time, and we'll talk to you soon. Thanks so much.
Thank you.